So welcome to our lesson on international financial markets. Even as multinationals operate and global business begins to get bigger or has been getting bigger, if I should put it that way, MNCs are trading in different currencies, and for that matter, the volume of trade in the various currencies give rise to an international market, especially the market for exchange rates. And so within that market also, the need for financing, short-term financing, etc., gives rise to other markets like international credit markets. And when they want longer-term financing, they're going to have the international bond markets, etc. So for this session on international financial markets, our learning objectives will be to, one, describe the corporate use of the foreign exchange markets, the international money markets, the international credit markets, the international bond markets, and the international stock markets. And then we're going to discuss the motives for investing in foreign money markets. We would also try to explain the motives for providing credit in foreign markets, analyze exchange rate effects on investing, analyze exchange rate effects on borrowing. Now, to a large extent, there are a number of motives for using international financial markets. Now, in a sense, the market for real or financial assets are prevented from full integration because there are barriers like taxes, tariffs, quotas, labor immobility, culture. So these are barriers to the integration of markets, or should I say seamless integration of such markets. So these imperfections, in a sense, create opportunities for specific geographic markets that will attract foreign creditors and investors. Now, for investors in particular to invest in foreign markets, it is because they want to take advantage of favorable economic conditions. So for instance, if we expect that the currency of a certain economy or country is going to appreciate, then of course, if we invest in that place and then they have to pay us back, or we're going to be recouping whether dividends, etc., with every payment, that appreciation of the currency compared to ours would mean that we convert that currency into a local currency and we're going to have more. On the other hand, if it comes to borrowing, then we want to work in the reverse. And so when we expect foreign currencies to appreciate against our own, we typically, like I said, we invest, because when the flows from those investments are coming our way, when we convert them, we get more of our local currency because those currencies have appreciated. And then, of course, the motives for investing in foreign markets also is because we can reap the benefits of international diversification. Of course, different things affect different economies. And so by diversifying internationally, you expose yourself to different versions or different forms of risk. And for that matter, it minimizes your overall risk in general. Now, when it comes to providing credit in the foreign market, here you are lending. And why would you lend? Or in this case, so the main thing also is that you want to capitalize on, when you lend, of course, it means that you're going to be benefiting from interest rates. And so higher foreign interest rates will be one key motivation. And then when you expect the foreign currency to also appreciate, in which case then the appreciation of the foreign currency means that when principal and interest are paid back, they convert into larger amounts for the local currency, and also to reap the benefits of diversification. So in a sense, providing credit and investing in foreign markets have similar outcomes or similar motivations. On the other hand, we do borrow in the foreign markets. And we do that because we want to capitalize. Of course, when we want to borrow, we would want to have lower interest rates. And so when the foreign market provides lower interest rates, we take advantage of that. And when we expect that the currency of that country is going to depreciate, what it means is that repayments would not be as problematic or as stringent as would be expected. And so those are some of the motivations for this. Also, we have the case that, okay, how the foreign exchange market facilitates international trade and financial transactions. So like I mentioned earlier, as economies continue to integrate, and then of course you look at the foreign exchange market, what you're actually beginning to see is the fact that each country has its own currency. So beyond the Eurozone, of course, where we have about 19 countries, I think after the Brexit, then of course, but even they were using the pound still. But what if we have a number of countries that are using the euro? So if you take those ones out, every country typically has its own currency. And so as countries begin to trade, the foreign exchange market allows us to exchange one currency for the other. In a sense, if I export, or if a Ghanaian firm exports to the US, they will receive their payment. They are likely to either choose to invoice the firm in dollars because that's the destination. And then when the firm pays, it will pay in dollars, but we do not deploy dollars on the average Ghanaian market. So when it comes in, it has to be denominated into cedis for use. So those are some of the things. So the foreign exchange market allows for the exchange of one currency for the other. And this is typically done through large commercial banks. They serve the market by holding inventories of certain currencies, usually the more popular ones. So you find the euro, the pound, the dollar, etc., to be able to accommodate requests by individuals or multinationals for currencies for various transactions. Now, so at any point in time, we actually can have the currency of one country being quoted in the value of another. So one of the ways you can look at it, for example, is the fact that because we deploy cedis in Ghana, then the dollar is the commodity that is going to be traded because that's the odd thing on the market typically to be traded. And so we have the spot market where we can easily change dollars to cedis or cedis to dollars. And that we refer to as the spot market. And usually the players in here for what we do know typically will be the banks as well as the forex bureaus. Then we have trading between banks that also occurs on the interbank market. And then we have the forward market. Here, an MNC is enabled to lock in an exchange rate at which it will buy or sell a certain quantity of currency on a specified future day. So, for example, we have issued an invoice to a firm that is likely to make payment sometime in the future, or we have also received an invoice for which we are supposed to make some payment sometime in the future. Because we do not know the movement that will, or we expect that the movement of the currency may go against us, then we would want to lock in an exchange rate at which we either buy or sell a certain quantity of currency and a specified future date, which normally would coincide with when the transaction actually needs to be made. So then we go on to look at some of the cases. So like I mentioned earlier, the foreign exchange market allows currencies to be exchanged in order to facilitate international trade or financial transactions. Now, because we are looking at the foreign exchange. So in this case, let's work with, let's say, the dollar versus the cedi. In Ghana, therefore, it is the dollar that we are going to be trading as a commodity. And so the banks may want to sell us the dollar or buy the dollar from us. So within the space of the foreign exchange market transaction, especially on the spot rate, which we're going to be focusing on, is the fact that the ask rate is the price that the bank is asking us, of course, is asking to sell dollars to us because that's a commodity. And then the buy rate or the bid rate is the price at which they will buy dollars off us because the dollar is typically not what we use in Ghana. So they buy it off us or they sell it to us. And so the selling rate or the ask rate, therefore, less the buying rate over the buy rate gives you something akin to a margin, meaning selling price minus cost price over selling price gives you something of a margin. And that's what we call the bid-ask spread. So it's the ask rate less the bid rate divided by the ask rate. And so suppose the bid price for $1, meaning that if you have $1, the bank is ready to buy $1 off you at 5.7. However, if you want them to sell you $1, which is a rare commodity, they are only ready to sell it to you at 5.8. And so therefore 5.8, which is the selling price, if you look at it as a commodity, it's the bank that trades in it. It is the bank that is able to sell you dollars. And if they are buying dollars off you because you cannot use dollars immediately on our market, they will take it from you at 5.7. Scaled by the selling price on the bank market of 5.8 means that the spread is 1.72. Now, this spread typically to a large extent is influenced by a number of things. It has to do with the fact that if there's competition, then you're likely to find the spread being smaller because then the banks are competing for the currency in question. On the other hand, if you find that that currency is not so tradable, then the spread becomes bigger. And so there are other factors that could also influence the bid-ask spread. So you could have how much it costs to keep or stock up that particular currency. And so ordering costs, getting it, the order costs are the cost for processing orders, including clearing costs and any other costs of recording transactions can actually increase the spread because it makes it more expensive. Inventory here, we are looking at the cost of maintaining an inventory of a particular currency. So depending on whether the opportunity cost of holding that currency is high, then we expect that to translate into the spread because then, on the other hand, the more intense the competition, the smaller the spread because then it would allow us to gravitate to whoever is able to offer a good price. And then, of course, the volumes also help. But where there's currency risk, which means that there's some serious volatility, then it also increases the spread because they have to hedge against such potential losses from the volatility within the currency. So typically, it's easy to look at the bid-ask spread and also make a decision as to whether or not that currency is potentially volatile, has competition, is easily tradable, etc. Now, when it comes to the quotation of within the foreign exchange market, we have what we refer to as direct quotations, and then we also have indirect quotations. Now, when you talk of direct quotations, it just represents the number of units of the home currency for one of the foreign. So we are quoting the foreign currency in terms of its value within the home currency. That's why it's direct. So if you take $1, for example, if we have 5.8 as the value of $1, this is a direct quotation. So we have 5.8 to 1. Currently, I believe we are working around a 13.67 thereabouts to 1. So that's the direct quotation. When you say indirect quotation, what it means is that you are looking at one value of your money and how much of that foreign currency gives you. So here it's indirect because you're looking at how much of a foreign currency are you getting in relation to one of your local or home currency. And to a large extent, when you look at the direct and indirect quotation, they are literally reciprocals of the other. So if you look at the equation before you, you find that 1 over the direct quotation gives you the indirect quotation. So you can try your hands on these examples. So you have the direct quotation being 5.8. So 1 over 5.8 will give you your 0.17. That tells you that 1 CD is equal to 0.17 USD per the exchange rate we have your 5.8. And then, so if you do another swap, you realize that your direct quotation can go this way, and the indirect quotation will also come this way, meaning that for if you have the value for a direct quotation and then, or you do not have the value for a direct quotation, but you have the value for an indirect quotation, you should be able to actually compute the direct quotation and vice versa. And so that's 4. Now, there's a possibility that sometimes you may have 2 countries' exchange rates being quoted in relation to, let's say, the Ghanaian currency. So if you take 2 quotes with a common currency, so you take the Ghanaian cedi to £1. So a direct quotation means that if you get £1, you're going to get 8.1 cedis. And on the other hand, if you have £1, it gives you $1.4, meaning that $1.40 is also equal to a pound. What it means is that whether in Ghana cedi of 8.10 or in dollars of 1.40, they are all equal to the pound. So if you were to look at it from that angle, you would say that we can then infer the implied rate of cedi to dollar, meaning that, strictly speaking, because 8.10 has the same value as £1 and $1.40 has the same value as £1, then it means that 8.10 Ghana cedis and 1.4 USD are both worth the same, or they are equal. So the cross exchange rates, we can then say that 1.4 over 8.1 should tell us that indeed 1 Ghana cedi is equal to 0.17, which is just about what we got in previously using the currency, meaning that our $1 is roughly 5.8. And so you can see that with that, you can actually get the implied cross rate. And that's another way. So cross rates, you have one currency relating to 2 different, and you should be able to get the third implied rate from the one that has not been quoted. So that's one way to go about the cross rate. Now, if it so happens that because this is a riskless transaction, for the market to be, should I call it efficient and perfect, it shouldn't be at any point that when we do a conversion through the cross rate, we should end up with a value that is different from what we would get from a direct quotation. So if that doesn't happen, then there's a possibility for riskless profit, which is what gives rise to the concept of arbitrage, meaning that we can buy one currency, convert it to another, and convert it to the next one. And by that conversion, we make a gain and we can take it from there. So the cross exchange rate at all times, all things being equal in an efficient market, should actually not be different from the quoted rate. Now, we also have the market for currency futures and options market. And here, briefly, with currency futures, specify a standard volume of a particular currency that we seek to exchange at a specified settlement date sometime in the future. Now, futures contracts are more standardized, etc., and they are traded on exchanges, unlike the forward contracts that are more to do with the individual parties that are contracting. Then we could also have currency calls. So currency call options, of course, will give you the right to call, in the sense to call for buying purposes. And currency put options give you the right to sell a specific currency at a specific price, which we already know to be the strike price or the exercise price within a specific period of time. And we're going to deal more with this later in subsequent chapters. Now, typically, for just like domestic firms may need working capital or money to make up on some short-term obligations or have excess money that they may want to put away, multinational companies also face such. And so there are financial institutions in this market that serve multinationals by either accepting deposits and offering loans in a variety of currencies. And so that's what takes us to the international money market, operating typically like the average banking setup. And of course, both European and Asian money markets originated as markets involving mostly dollar-denominated deposits. And so we also have the euro currency market that developed during the 1960s and 70s and mostly stimulated by the regulatory changes within the US and the OPEC. So that's very trading. So when you get to the euro currency market, most of the time with euro dollar as one of them, it's usually whenever we mention the euro dollar, it's actually dollars operating outside the typical jurisdiction of the US. So you could talk to them like you refer to as international dollars, dollars that have crossed over. So normally MMC sometimes can obtain medium-term funds through banks located in foreign markets, and that's for the credit market. And so we have Euro credit loans, and these refer to loans of 1 year or longer extended by banks in Europe to foreign multinationals or government agencies. So that's for the Euro credit loans before we speak to Euro dollars. Now, when it comes to the rates that are applied, they have floating rate loans, and these are usually based on the London interbank rate, and that's what is used normally in pricing. Now, if a single bank is actually unwilling or unable to lend the amount that is actually needed, a lead bank may organize a syndicated loans with the other banks. That, in a sense, allows for the spreading of risk, or should I say, to mitigate exposure from just a loan bank taking up the whole responsibility. Then, of course, we have the bond markets, and no different from the typical bond market you may have in a home country. So we have foreign bonds. Foreign bonds, this is issued, or these are bonds that are issued by a borrower foreign to the country where the bond is placed. And so if a Ghanaian firm or a Ghanaian firm that is of a multinational status goes to issue bonds in another country, those bonds are considered foreign bonds. Then we have Euro bonds. These are bonds that are sold in a currency other than the country of the currency denominating the bonds. So you could have a cedi denominated bond actually being sold in another country or crossing the border. You could have those Euro bonds. Usually they are denominated mostly in dollars anyway. But bonds that are sold in countries other than the country of the currency denominating the bonds. So usually Euro bonds are underwritten by a multinational syndicate of investment banks and simultaneously placed in many countries. Now, when it comes down to the rates that apply within this market, and of course, it's not one rate because they are different countries operating, you realize that for a multinational, therefore, you will be faced with different interest rates to work with. And you may notice that the interest rates will differ. And so the question then is, why do interest rates differ across different currencies? Ordinarily, the first response would be to say that this is due to supply and demand, but there's little understanding on that level. So we want to break it down a bit. Evan Fisher says something that when it comes to interest rates, there are 3 elements that you want to look at specifically. Time preference, what we also like to call deferred consumption. And so there's a lot of joy to be derived in consuming now versus deferring for later consumption, because of course there's a risk that you may never see the later. And so for that, you need some compensation. Then there's also the risk that your investment may never come back or it may lose value or anything for that matter. And so they have the deferred consumption, should I say compensation, then the risk compensation. And also there's supposed to be compensation for inflation, meaning that the purchasing power of the money. So if, for example, you take time preference or the deferred consumption reward to be 1%, and then the risk inherent in the fact that the money could actually lose value or not come back or anything can go wrong, the risk of losing that investment, together the time preference and the risk become the real rate of return. And then there's the inflation, which then adds on to give you the nominal interest rate. So together we have, let's say, time preference is 1%, risk is 2%, inflation is 3%. That gives rise to a 6% interest rate on one currency. Now, when you want to compare across different currencies, you realize, for example, time preference, the assumption is that human beings are just about the same. So there's no reason for there to be a difference. If you defer their consumption, you pay them or you reward them equally. And then also the possibility that the money would not come is also given a similar rating. However, so what it means is that real rates to a large extent are just about similar. The difference, however, in the overall interest rate is therefore fueled by the inflation rate, or in this case, the premium that is offered for the risk of inflation or inflation risk. And that is what separates. So you can see that for country A, with an inflation rate of 4.5, in addition to a real rate which captures time preference and risk of 2.5, we end up with an interest rate of 7%. On the other hand, for country B, that has 2% less inflation compared to country A, they always therefore end up with an interest rate, a nominal interest rate that is 2 points less the 7% of country A. And so that is what you'd. And so what it really means is that should you invest in the country with a higher interest rate, the nominal interest rate, the inflation that is expected to affect the value of the money would ensure that at the end of it all, if there's parity, which we'll deal with much later in the course, the conversion would end up putting you on the same level as somebody who invested in country B and earned 5%. So now when it comes to the international market, we also have the stock market. Of course, that's for raising equity. So beyond issuing stocks locally, multinationals can also obtain funds by issuing stocks on international markets. Usually they do this sometimes to enhance their image, broaden their name recognition, and also diversify their shareholding base. And of course, the location of a multinational can actually influence the decision about where to place the stock due to cash flows that may need to pay dividends. So if they have a lot of their cash flows coming in dollars, then they may want to be listed at a market or on a market that actually has the expectation of dividends in dollars. And then, of course, there are also other benefits for which reason they may move on. So market characteristics, the size of the market, the trading activity level, institutional share ownership. These are other drivers of why the stock market, international stock market, may be appealing to multinationals. So to a large extent, when it comes to the international financial market, we have the money market, we have the credit market, we have the bond markets, so that's the international bond market, international stock market. All of these, remember, underpinned by the bigger one that we cannot ignore, that is the foreign exchange market, partly because for each country to have its own currency, and for that matter, trading requiring that you exchange your local currency for a foreign currency to be able to either purchase or invest in that country, or the reverse where you receive payments and you must convert into your local currency to be able to deploy the funds. The foreign exchange market continues to be crucial, and so it's important to begin to appreciate the essence of the spot markets, the forward markets, the spot rates, the direct quotations, the indirect quotations, the cross-exchange rates, and how these can inform decisions within the space of multinationals. So in terms of reviewing and trying to understand the lesson we have just gone through, it's important to understand why a multinational may invest funds in a financial market out of its own country. We should also be able to explain why some financial institutions prefer to provide credit in financial markets outside of their country. And of course, be able to explain how appreciation of one currency would affect the return to, let's say, a Ghanaian domestic firm that invested in the US money market security. So, for example, if the US dollar were to appreciate relative to the Ghanaian currency, the cedi, how will that affect the return that a Ghanaian firm that invested on the US money market would make? Also, we need to be able to explain how the appreciation of the British pound, for example, against the cedi will affect the return of a Ghanaian firm that borrowed, in this case, British pounds, and used the proceeds for a project in Ghana. And then we have a mini case that you could also discuss and explain amongst yourself. Then we also have another set of review questions, which will trigger more for discussions within your study groups, etc. Whether firms should go public or firms that go public should engage in international offerings, and why we believe that a terrorist attack on the US is expected to cause a decline in US interest rates, etc. Of course, the implications for political risk, etc. And then also explain how the international integration of financial market caused a credit crisis to spread across nations, and also a case of the countries, and then implications of how one weak currency could actually also cascade within another or through to another. Now, so that brings us to the end of lesson 2. I would entreat you to actually spend some time to understand the workings of the foreign exchange market, be able to compute the bid-ask spread, for example, to be able to compute the cross-exchange rate, and be able to indicate where opportunities for arbitrage exist and how these can end up affecting decision-making.